Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, October 26, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at some options earnings play this week and kind of break down the different pieces and what to look for and the stuff that I'm kind of doing before I enter an option trade. But before we get to that content, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. We'd love to hear what you're trading, love to hear what type of content you want to hear about. You can also pick up this episode wherever you get your favorite podcasts, and if you can't find Blockhead Traders Weekly there, let us know and we will get it there. You can also follow each and every one of my trades, the good, the bad, and the ugly at thetagang.com/sprocket888. But let's hop to this week's content, Viper. So last week, Viper, we really kind of stepped into price action a little bit and talked about different levels and how to take that information and make a practical application of it in today's market. And I really thought we could do the same this week, but on my favorite type of play, and that is the options earnings play. And so I kind of wanted to take you through some of my checklist. I want to show you what values I'm kind of looking at, what I'm seeing, how I make the decision, and then talk through this week a potential earnings trade in Amazon. It's right up there. It meets a lot of my criteria. So we'll use that Amazon upcoming earnings as an example this week of how this fits into my criteria and what type of stuff that I'm looking at. First, let's bring up the criteria. And I've kind of broken this down into different things that I'm looking at. And you'll notice that I have musts and I have nice to haves. And so this is pretty much the order of operations that I'm really looking at when I'm evaluating earnings trades. And keep in mind, this is a earnings trade with options that I'm looking at playing. And this is a binary event. You've heard Viper and I talk about binary events. This is a singular event that's coming onto the market. You know when it's coming, and it will spark an accelerant of price movement. And it leading up to this binary event, volatility builds. And so really when I'm playing earnings, I am looking for a very volatile stock that is historically over volatile or historically stretched in the volatility direction. And so the very first thing on my screener when I'm looking to make earnings trades is I want something that is known as a very liquid underlying. And what that means, I typically look at volume and I look at what's known as the bid-ask spread. So how closely are the bid and the ask prices on the option chain? So the tighter those are, the more liquid the options are. And I also typically like to see multiple millions of shares traded, not options, but actual shares of the underlying traded on any particular day.
So on that bid-ask spread, what's a typical range that you see, and then what's extremely narrow, and the probability or the kind of thing that you would see that extremely, like, is 5 cents, 10 cents, that sort of thing, and then on the other side, like $1, $2, like what's a this is too much bid-ask spread?
Yeah, that's a great question, Viper. And so let me just switch up to an option chain here because I think seeing it will help conceptualize that. So this is the option chain on Amazon, which we're going to look at a little bit later on in this video as well. There's a column here for the bid and a column here for the ask. So this is what the buyers are willing to pay it for and what the sellers are willing to sell it for. And so I typically look for the spread when you're close to the money. So right now, Amazon closed around $115. The markets are closed right now, so all these are kind of frozen, but normally they're changing. And so what I'm going to look at for And it's good to do this when the market is live. Don't try to do this when the market is closed, because as the market closes, you can get weird bid-ask prices locked in to the brokerage software. So if you're evaluating this after hours, it might not really be representative of what's happening when the market's open. Amazon's not usually that bad because it's just so high in volume, but this is what I'm looking at. And so when I say the spread, this is a 10-cent spread here, 385 to 395. The 114 strike is a 15-cent spread, then 113 is a 10-cent spread. Here you got your 6-cent spread, and these will probably be a little bit tighter if the market was open. But for me, anything that's under a quarter is usually pretty good. You kind of got to check that against the underlying. And so if we were having like a 15-cent spread on an underlying that was a $20 underlying, that's not as good. I don't like that as much. But relative, I'm generally looking for less than a quarter difference.
Okay.
So let me jump over here from the option chain to what am I actually looking at? And I'm not going to get real hung up here on going through each of these things, but I talked about high volatility, high volume. High volatility is the next bullet point down. So I'll mention it here and then I'll show it to you again. And this is the screener that I use for earnings. And one of them says, hey, you have earnings in the next 3 days. So now I'm only looking at earnings that are basically upcoming in the week. If I'm looking at this on Monday, I might say in the next 5 days, because what I'm looking for is what earnings are that week. So I only want to see shares with earnings that week. I have, hey, what is the average volume over a 5-day period? Just regular, simple average daily volume. And so I'm basically looking for at least 1 million shares a day on average. Now, that's just to get something on the list. I typically want to see greater than 9 million shares a day or on the most recent day. And so, you can see, hey, here's all the companies that have earnings. One of the fields that I add is this IV percentile, and I'll show you this in a second. This is the historical volatility. So I want things to be as high historically as they've been. And pretty much this number is going to be between 0 and 100 because it's relative to where the stock has been and it's a percentage. So, this first veil is basically for the past 52 weeks, 98% of the time, the volatility has been lower. So this is an underlying that is very high historically. And you can see, right down here on the list is Amazon. That is at 87% historical volatility. And this one jumps out to me because look at this, 69 million shares. So I would kind of skip over this volume of 1 million. Like, I'm not really interested in those. The other thing I kind of look for is, do I know what the company is? Teladoc, yeah, I know what that is. Upwork, I know what that is. Align Technology, I don't know. Don't really care. So this is kind of the initial screening that I'm looking for. So I'm looking for these candidates that have a high IV percentile and have very good volume. And this is where I would then pull up the Amazon option chain, which we just had pulled up. And that's where I'm going to look at the bid-ask spread. So if we were to hop back over there, this is where I would look at Amazon and I'd say, oh, great, we're under 25-cent spread. We're a liquid option. So back of the slides, you can see, yes, the first thing is, do we have a liquid underlying that has earnings this week? And the next piece is that historical volatility. And I started to show you that in the screener where Amazon was in the 87th percentile, Vail was in the 98th percentile. And so let's just look at that historical volatility in just another perspective. This is another way that I do look at it. It's basically in the chart of the view. So if I was to pull up the Amazon chart, this graph that is down below the thin blue line is the implied volatility of Amazon for the past 52 weeks. So if we look at this thin blue line, this is the historical volatility. And you can see as we rise, we get this spike here. If you look at the top of this chart, you can see these little red bubbles, blue bubbles. You can see each of these are the earnings announcements that came out. And look at what happens to the thin blue line under each of these earning events. The volatility usually creeps up and then collapses. This earnings, we get a little bit, it doesn't collapse as much in this one because we actually went down in price, but even though we dropped off a cliff for earnings here and we slid, look, the volatility still declined a little bit. So we can come up here again in August. We've got another red bubble, blue bubble on the top. That is another earnings announcement. And you can see on this thin blue line, volatility again dropped off. And so each of these earning announcements, you get this volatility contraction. And what do you have essentially from September to now is this rise in volatility. So this thin blue line is really close to the top here, as close as it's been to the top. If you look back over those 52 weeks, this is exactly that high historical volatility. And so we saw a singular point in time number in that screening criteria where Amazon was showing 87%. But this thin blue line shows you historically where has that price been, because you might be in the 87th percentile, but if most of the rest of the year you were just a tiny bit below it, okay, you're not really that elevated. Yes, you're in the 97th percentile because you've never been higher, or whatever number happens to be. But if you look back historically, how much variation is in that line? How much does it go up and down at earnings? That's what I'm kind of looking at here. And there's no very pure number or pure way to look at this. It's more of a feeling, a gut. When I look at that, okay, look, it's kind of climbing. We've had these periods of contraction. It's definitely very high. So to me, that is matching that criteria. So what's next on my checklist? So the next thing on my checklist is position sizing. Is position sizing okay? Now, this we did a whole episode, many episodes referencing position sizing. And you should only really be playing in stocks that you can afford to pay for. And the reason that I'm looking for position sizing okay is because there's a difference between what an option play on a $20 stock is versus an option play on a $100 stock versus an option play on a $1,500 stock. And so you have to do what's right for your portfolio and your position size. So for me, I do not like to play anything that requires much more than $2,500 of buying power. That's just where I like to have my position sizing. If the underlying was a $500 stock, $600 stock, that wouldn't fit my bill. Amazon, in this particular trade, you're probably looking at $2,000 to $2,200 buying power. So that's it's on the higher end, but it's within my position sizing. If this had been, a $50 stock, that's definitely within my position sizing. And so part of this question here is, does this fit your position sizing? And that's really the three musts. So if any one of those fail, I'm out. I don't consider it. So we have to be high liquid, we have to be high historical volatility, and it has to fit my position sizing of my portfolio. So it's important to remember here that this earnings play is not a play on price, okay? The earnings play when I sell options is about volatility contraction. So we are going to be selling premium. I will be selling a put. In selling that premium, I am selling that volatility, the risk associated with that volatility, because I'm expecting that volatility to go down. And when that volatility goes down, the premium paid for the option will also go down. So I am selling the option now to collect that increased premium. I am anticipating a volatility contraction. So when that happens, I can close out my position by buying that premium back at a much lower price. It's very similar to shorting a stock, but what you're doing is you're shorting the volatility. And that's very important to remember because price can actually go down, volatility can collapse, and you can still make money, because what we're selling is we are selling volatility. We are short volatility on this earnings play.
I want to drive that point just a little bit harder. Can we pull up the volatility chart? So that's going to be the blue down there at the bottom, correct?
Yep. The thin blue line is the volatility.
Yeah. So for all intents and purposes, look at that like a price chart, you know? I mean, for all intents and purposes, that could be a line chart of an underlying price. And if you look at it through that lens, like you just said, like this thing looks oversold, or it's, you know, it's setting these all-time high. Like you want that, if it's a price chart, you want to short that. And so that's kind of what we're talking about, right?
That's absolutely what we're talking about. So one of the things I would mention there with volatility is in a lot of studies and historical reviews, volatility is often always overstated. And the reason that I say that is because volatility, I equate it to insurance, is when it's stormy outside and it's just ugly out there, people are panicking, everybody runs volatility up because they're worried, they're freaked out. And that premium almost always is overstated. And so when you get it in an elevated state, your probability of a volatility contraction, because one, it's already overstated, and then the binary event of the earnings is an accelerant, because part of the reason volatility ramps up leading into earnings is because of the unknown. As soon as the unknown is out there, volatility just completely contracts. And so actually, let me bring up a different chart to show you kind of what happens to volatility at earnings. So in my particular broker, they have an analyze tab. This is in Thinkorswim. It's by TD Ameritrade. And what you can see here is each of these boxes that I'm going to highlight is a different quarter of earnings. Now, this swim lane here, volatility, red line, is the volatility leading into earnings. This line in the middle of the chart is when earnings were announced. So Q3 of 2020, look at that volatility contraction. Here it is. Q4 again, contraction. Q1, contraction. Look at every single one of these. Drop, 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 drop. And that is the volatility contraction around earnings. And so it's a thing, it's a real thing, and that's what we're playing here. We're playing for that contraction in volatility. So the next point, now the remaining points here are really going to get into the nice to haves. So for me, like I said, the three first things are absolute must. You don't have one of those three, you're out, don't play. The next ones, they just basically further empower or basically reinforce the play. So the more nice to haves you have, the more likely I will be enter the earnings trade. If we're missing some of the nice to haves, it may or may not deter me from the option play. And so the first one on there is the volatility high? And this is, you might say, of course it's high. You told me it was, in the 87th percentile. But I want to tell you what this means is that percentile is historically within the range that volatility has been. Is it close to the high side of the range, or is it at the low side of the range? The actual volatility that I'm referring to here is, what is the volatility number? And an example I would give you is take a utility. If you go look up a particular utility, a utility's volatility might go between, let's say, a number of 5 and maybe 20. And that might be the volatility range, which are actually really low numbers when it comes to volatility. So the premium is not that great when your volatility is kind of that low. But you could be at a volatility of 19, which could put you in the 90th percentile of volatility. So you could be contracting. The difference is your volatility number is not that high. It's 19. Okay, well, that's not that great. And so when we're looking at Amazon or any of the other ones, it's what is that volatility number? And in Amazon's case, it's currently at like 56% volatility. So typically in underlyings, as long as the volatility is above, say, 35%, and we're in that high percentile, that's what I mean by is the volatility high. we could be in like the 95th percentile of volatility, but maybe volatility is like 15. Doesn't really meet my nice to have. And so it's kind of a nuance, but it's one of those things that I'm going to look at is how is that volatility from a raw or immediate number. So next on the list of the nice to haves is price in an uptrend? And this, you could take this question to mean, is it on an uptrend in the past 3 months? Is it an uptrend in the past year? What's the time frame that you're looking at? And to be honest, what I'm really looking at for this is the price in an uptrend. Is really just going back to looking at the past year and just eyeballing this thing. I'm like, are we generally moving sideways? Are we generally moving up? Are we generally moving down? And so on my chart, I have a couple of moving averages called out. The red one is a 200-day moving average. The yellow one is a 50-day, and the green one, these thin lines up here is what I'm referring to as the green one is a 21-day moving average. And so if I look at this, are we generally sloping down? Are we kind of coming up? And this particular, it doesn't really say much whether we're up or down. I would say we're kind of moving sideways. There's kind of a channel maybe between 100 and 140, somewhere in there, and we're at 116, so we're kind of at the lower range of that. This is just kind of a gut check. This is not a very detailed price action. This is not any deep analysis. This is me just kind of looking at the past year and saying, do the squiggles generally trend up? Do they generally go sideways? Do they generally go down? And the reason I basically mention, are we in an uptrend? Because I will be selling a put, which is basically saying I believe the stock will not crash low, like really far down. So if the stock goes down a little bit, it's fine. If it goes sideways, it's fine. If it goes up a little bit, it's fine. If it goes up a lot, it's fine. And so I like to see trend lines that are not declining, but trend lines that are either moving sideways or up. And that is this nice to have point. So the other nice to have that I look at is, am I okay owning the shares? Now, this is a pretty subjective thing for each and every trader. I used to play earnings, never wanting to own shares, and I would say, nope, if this price tanks, I'm going to just cut my losses and walk away from this thing. I've kind of been changing my attitude towards that, not from a standpoint of, profitability or something like that, but I just want to be able to sleep at night and sleep when the earnings come out. Because when you play earnings, you are at the mercy of the market after hours. You cannot close your options trade. Options trades can only be done during market hours. Earnings are always released post-market hours, after either before the bell or after the bell. And it can be very stressful to have an option play out there and have it go against you where the price is dive bombing. You sold a put, you're way in the money, they totally biffed, and you're like, oh my gosh, this option's going to be so red in the morning. And for me, if I'm okay owning the shares, then I've already had that moment of decision in my mind that says, look, if this thing tanks, I'm okay buying this at whatever strike I sold, minus my premium. I'm okay with that. So is it sad? Yes. Is it stressful to me? Not really, because I've already come to peace with the fact that I'm okay owning the shares no matter what the outcome is. So for me, I have to be okay to own the shares if I'm entering the earnings trade. You might not want to do that. You might want to take different hedges. You might play it differently. It's a nice to have for me, but that is one of my next criteria.
And I would even call out on this point, kind of linking a few things we talk about regularly on the show. But also right here on the slide, position sizing okay, and emotion. Because even when I've played earnings or done naked puts, and I've checked this box with the greenest of pens of like, I am okay owning these shares, then it happens, and it just moves way in the money, like you said. And there's still, even though I'm okay holding these shares, the first few times it happens, there's just a big emotional impact of like, first of all, you see a ton of red, because you're still looking at the price of the option. So there's that emotional factor, and then just the emotional factor of now it's below your quote unquote buy-in price if you get assigned. And so that's all just to say, like we say over and over again, that there are just so many emotions you cannot prepare for and you have to experience in the moment. And so for anybody that's thinking about doing something like this, really focus on that third point of position sizing. Okay, go down to a $5, $10 stock or something that, it's now you're okay holding it, and it's, maybe whatever the price is, that's going to be 5 or 10% of your capital or something like that. So now not only are you okay holding it, but it's not going to be this giant lead weight on your back until you can cycle through those emotions.
Yeah, if you're new to this, I will reiterate, definitely start small. Definitely start with what are known as verticals. My very first option trade of all time was a 50-cent wide vertical on Kohl's. For the 50-cent wide, that I was $50 wide. I think I collected $13 on it. It won. I didn't. It finished out of the money, so I got it. But yeah, at most I was risking $50.
Yeah.
Now, the last nice to have, and this is something I'll typically look at, is where is the price action on the chart of what I'm playing relative to the expected earnings movement. So what I'll do here a lot of times, and I'm going to hop to the option chain to show you a few numbers to look at, but what I will typically do is I'll typically bring up the chart. I will typically start charting a couple of levels that you've seen Viper and I do on the show in the past. And then I look at what is the expected move of the option, of the price of the underlying, I should say, on the earnings announcement, and where does that look like on the chart, and where does that fall with upcoming levels. So you might ask, where do you get this information? So let's go back to the option chain, because I want to call out a couple of numbers on this option chain and how you read an option chain. This is the option chain on Amazon, and what you have here is a bunch of dates. We got some numbers in parentheses. You got some other things in yellow. So let's just take you through this. The top of the chain, those are the things that are expiring first. This first date is the date in which the option expires. So this first set are options that expire this Friday, October 28th. The next ones expire next Friday, November 4th. The next one is expiring that Friday, November 11th. Okay, the date in this parentheses are how many days are left before those options expire. The yellows are basically weekly options, which means they expire weekly. The ones that are not yellow are the traditional monthly options. So those will always be expiring on the third week of the month. And that's basically how you read some of these numbers. Now you're like, well, how do I know what the expected move is? There's two primary values that you can look at. The first one, which will be available in every option chain from every broker, is this number over here next to the percentage. So this percentage is the volatility, the spot volatility of these options. So options that are expiring this Friday in Amazon have 133% volatility. And then this number in parentheses, it says plus minus. This is the expected move in price by Friday. So this is saying by Friday, the option traders are expecting Amazon to either be $1 or $8.60 higher or $8.60 lower. That is the range that they are applying to this move. Now, you could extrapolate that that's likely all due to earnings. So the earnings movement is probably about $8.50 potential. Now, Thinkorswim actually has they call it a proprietary algorithm that basically is this MMM, this triple M number, and it stands for something like market maker move or something like that. So when there are some upcoming event known, doesn't have to be earnings, but some, drug release or something like that, you'll find some options only in the Thinkorswim platform that have this MMM. And this is their formula that basically says this binary event that's upcoming, we're expecting it to move $7.92, either up or down from whatever that event is. And so the week of earnings, this number is typically means the expected move from earnings. And you'll notice that's pretty darn close to this number over here of $8.60. And the difference is because these earnings are on Thursday, they're maybe then expecting just maybe 60 cents move on Friday, if that's how you can kind of read those two numbers. And so the thing I want to also draw your attention to is look at as we travel down these expiration dates. The farther we get away from earnings, you see November 4th, oh my goodness, we dropped 50% in volatility, 50%. Because guess what? There's no binary event next week. So all the uncertainty, all the volatility, all that, possible contraction is the week of earnings, 133%. And so that's really important when you're looking for that volatility contraction. After earnings are announced, you'll see this 133 will probably drop down into the 20 or 30% number. So you're just going to get this massive contraction. And the prices that you see in the option chain, will dramatically go down. So if you're looking here at, say, a 25 delta, which would be about, $1.70 today, if you looked at this same strike the day after earnings, volatility would probably be down, 30, 40% in raw number. And so this price would probably be maybe 40 cents. The other thing I want to make note here is, yes, this particular, options expire this Friday, have 133% volatility. There's not much time premium in there. So like I said, that contraction will be very sharp. But what I want to make note of here is, let's say that we wanted to play this and I was choosing, let's say, 28 delta. So I would typically play between 20 and 30 delta. Let's just pick 110. It's a nice even strike. And it is currently, for $1.96, that 110 strike. I want to make note that if we went out to the monthly of November, which, by the way, has half the volatility that the other one does this Friday, the expected move is still almost $14. The reason is because we're further out in time. Premium is higher because we're further out in time. So there's more time premium, but it's still kind of volatile. And so that 110 strike, you can see, look, we're collecting almost $4 for. And so down here, you can see here's the October 28th weekly at $2. Takes a buying power of about $2,100. If we extend that out to that monthly expiration, you can see we collect almost twice the premium. It's not because volatility is higher, it's because time is farther away. And we still are, $2,100 in buying power. So this is a balance that you have to make between how much time do you want to burn away and how much you want that volatility to contract. So after earnings, that expiration this Friday is going to contract very hard because there's not going to be much time left. So that 133, like I said, is going to drop down probably 20, 30%. This monthly, which is currently at 60% after earnings, it's going to collapse. But it's probably going to collapse, maybe down to the 30 to 35% or maybe 40%. So it's still going to contract, but it's not going to contract as severe. But you could collect more premium. And if you think you have a longer bullish thesis, you might do better. So your return on capital in weeklies this Friday would be about 10%. You're collecting $2 on about $2,000. The return on capital for that monthly is 20%, but your time horizon is, 2.5 weeks versus 1 day. So that's kind of how we can kind of go to these expected moves. And like I mentioned, I will take these expected moves and I will put them into the price action charting to see what happens. Where do those expected moves land when it comes with respect to the price action chart that I might put together? It's a skill that I'm learning, but I know Viper has kind of spent more time on price action charting. And so while this isn't a make or break part of my decision, if price action happens to line up, that's really another arrow in the quiver for making the play. So Viper, I don't know if you got a chance to take a look at AMZN Price Action or not.
Yeah, of course I did, because we conveniently just took a look at this last week for our discussion with what was going on there. So let's take a quick look here and just kind of, I want to highlight the chart and also my take on how the chart plays into that checklist item there. So currently, as you can see, as of recording, we closed today 115.66. And without options, I don't really like this price for doing any buying or shorting. And these levels that you see here, we did these last week, so you can go back to last week's episode and find out how we came to the conclusion to draw these levels. But so looking at these levels, the reason I don't really like this price is we can kind of see that we had this bounce that we talked about last week, but now we're in kind of this micro downtrend after a little bounce that maybe we tried to make a reversal but didn't quite get there. We're in a macro and a micro downtrend here, and I don't like a short because there's not a whole lot of ways to move from where we're at. This is a major level down here around 100. So I don't really want to play for that short, and I also don't want to play for a long, because if we zoom in here, we kind of missed the chance to get more, to get a higher high at this moment, because we had one here, we failed to break that here. So it's just not feeling like that probability of success that we talk about to go long on it. So some additional things that I'm kind of layering into my thought process here is if we take a look at, like I said, there's this macro downtrend, which is this line here. And based on this, we're definitely still in the macro downtrend to me. Like I said, I also referenced this micro downtrend, as I'm calling it. And that kind of comes off of this channel move here. So if we zoom in now, and the anchor points for both of these are important. This was the all-time high, and I anchored this quote-unquote micro downtrend because this is the local high, and those are two important highs for a current trend. And so what I thought was interesting, let's get these other levels out of the way just to clear the chart up a little bit. What I thought was interesting was, and this comes with all of the disclaimers of any time I get into price action, this is me learning. And so this is just a current, how I'm viewing things at the current point in time. But I view these trend lines not necessarily as decision-making lines. I like to stick to the TA of those other lines we drew. But if we're going to make a potential reversal, I would want to see us break and then hold, at least one of these trend lines, and then ideally both of them. And to put that in a different perspective, I feel like if you could just rotate this chart. So I kind of did that, the power of Photoshop. So if we take that trend line and rotate it, now all of a sudden this looks very familiar. This looks like a level, and you can see that we hit it, we drooped, we tried to cross it, we lost it, we tried again, we lost it. Now we hit resistance off of it. So all of that's just to say that we're in this downtrend, and we're not at, bring all of these back and get this trend out of the way, we're not at a particular level that I think is great for entering. So for this options play, what I think is most interesting is, like we just looked at there, potentially maybe a 110 strike with a $2 collection. I want to bring back in that idea of being okay to hold what you're dealing with, because let's mark that 108 break even here, roughly there. Let me make it a fatter line so we distinguish it a little bit. So on earnings, if we do a play where we sell the 110 strike for $2, our break even on those shares is now 108. That's much closer to a decent buy-in, for one particular thesis you might have on the chart. But the thing I want to tie in is that position sizing, because these binary events are accelerators. Price could go below that 108, and now you need to be position sized appropriately and okay to hold for that. But it does showcase here, the way that price action could play in to something of, still making a play. We hit earnings, volatility contracts. We do not breach 108. Maybe we hit 110, maybe 111 on open. And as soon as you get that price that you want, you can close it up, buy it back, get the difference in your pocket. So to me, that's what I see on the price action is in summary, long and shorts. I don't like the price, but as we can see, the cost basis, the break even there starts to get closer to where I would be okay, like we talked about on the previous episode, of getting to where I'd be okay holding it on a price action analysis.
Yeah, and that's really important to remember that this is really about that volatility contraction. Looking at the checklist, volatility is right up there as a must. It has to be liquid. It has to have high volatility. Think back. So we put an episode on a pharmaceutical Veru, Veru. I'll put a link into it up here above. And really that underlying, I sold premium on that. That thing came down to my strike, actually a little below my strike. Still a good bit above my break even because I collected so much premium, but the volatility had collapsed so much in that I actually got 40% profit on that play, even though it came down to my strike. Now, that volatility was just insanely extended. I'd never seen anything so extended before. So that's not likely to be that extended in Amazon. But the point is, you still can make money even if this thing is moving against me to the downside because of that volatility contraction. And so it's another dimension to be able to kind of profit in, even when some of the other plays are not as interesting. And if you choose the right strike, you could potentially be basically putting what's effectively a limit order in closer to a strike you like, and you get to collect a little bit of premium while you're waiting for it. So I think it's good to kind of look at that as another metric when you're evaluating these trades. So just to recap here, this is the checklist of the things that I look at. The first two things are absolute musts. If one of those three are not there, the trade does not proceed. I do not bother looking at the other things. Those are absolute must-haves for all three. You must be liquid. I judge liquidity by the volume of the underlying shares and the bid-ask spread of the option chain. High historical volatility. What is the historical percentile that the volatility is on? That's a number that I look at. I typically like to see that above like 60% historical volatility, which means we're in the overextended region. I will also frame that by looking back in the past year about that volatility graph, that thin blue line that we showed. Think of it like price. When it's overextended, it's going to come back. There's going to be some consolidation. It's going to return back. It's a mean reversion play. I then will make sure that the position sizing can be handled, right? So there's stocks out there that are $500 stocks. That might not be an appropriate position size for you. $100 stocks might not be inappropriate, might be just perfect. You got to make sure that the underlying that you're trading and the options trade you're putting on fits into your position sizing. If you don't do that, you will not sleep well. You will put yourself up for a disproportionate risk reward. Just don't do it. Know your position sizing and stick to it. Those are the absolute three criticals. The rest of the things I'm going to look at, which is says, hey, the more of these that we check, the stronger I feel about the trade. The less of these we hit, the less likely I am to make it. There's no black or white. I'm in, I'm out. It's just how do these things stack up? How do they look like? What is the actual spot volatility that we're dealing with, right? Is this a utility where the volatility is, 5 to 10% versus a tech stock where that volatility can be in the hundreds of percent, 150%, something like that, right? For me, almost always that spot volatility has to be above 35 or I'm not even going to consider it. Is the price in the uptrend? That's something that I like to have. It's a nice to have. I'm basically selling puts, which basically mean I don't want the stock to dive south. I can take a little bit down, I can go sideways, I can go a little bit up, I can go way up, but I generally like to see, is the price in an uptrend? Uptrend is, I just look at a 1-year chart. I just look at the squiggles. Are they generally going up and to the right? Are they generally moving left to right? Are they generally going down to the right? Right? It's just a gut check. What does it look like if I zoom way out? What is the general trend? That's not the price action. Next one is am I okay to own the shares? Again, this is a personal decision for me where I sleep better if I know I'm okay to own the shares. Keep in mind, your option trades or option earnings are all happening after hours. You cannot exit your option trade. You are stuck into it till the market opens. So you're at the mercy of whatever happens after hours. For me, I sleep better knowing that, you know what, if it goes south, I'm cool with the shares. That's a personal choice I make. So I make sure to put in there, am I okay to own the shares? Lastly, which is the last method, I say, okay, how does this fit into the actual price action? This is where Viper and I have spent some time. Viper went through and lines it all up. Does the price action make sense? If it does, I'm more likely to enter. If the price action doesn't make sense, it still doesn't mean that I'm not going to play because, again, I am shorting volatility. And if I think the volatility contraction is going to outweigh the price movement, I'm in because this trade is all about shorting volatility. So that brings us to the end of this week's episode. Trying to break this down into a little bit more granular pieces, a little bit more practical application, kind of showing you what are the mechanics that I'm looking at as we enter a trade, taking you through my thought process, my thinking, showing you each of the steps. This is where I see it in my brokerage account. This is the number I'm looking at. This is the chart I'm looking at. This is why I'm doing it. Really just trying to lower the barrier to entry. I know this is a ton of information. If this is the first video you saw, you're probably lost. I would highly recommend you go back and watch some of our earlier videos, intros to trading, intros to options. We put them all up there, but fundamentally, just repetition, exposure to this. This is how we learn. This is how I learn. Just going through these practical applications as they make themselves apparent. Right now with earnings week, that's what's apparent out there in the market. That's what's easy to see. That's what's easy to talk about. So we might as well talk about these things, book them in the proverbial internet history book so we can someday look back and be like, wow, what the heck were you thinking? Or man, that was spot on. How knowledgeable you were. We'll see how well this video ages. Earnings will be out and we'll see what the price action happens on Amazon before this video is even released. So, earnings have been kind of a mixed bag. A lot of company beats, a lot of stocks have gotten beaten up because they've offered poor guidance moving forward. Volatility in the general market has come in, but not much. We got a Fed meeting coming up. Definitely still an exciting time to be trading. Hopefully you guys are all finding pockets of profitability here and there. Remember, have fun out there and think outside the block.